In 48 hours, the silver market showed you something most people only learn after it's over. When the plumbing gets stressed, price doesn't move like a chart, it moves like a trapdoor. On December 29th, 2025, a single rule change hit the market with the force of a cash call. The margin requirement on the March 2026 silver contract was raised by $3,000 from roughly $22,000 to $25,000 per contract. That doesn't sound dramatic until you translate it into what it actually is: a sudden demand for immediate cash, delivered straight into the middle of a volatile move. They said a market this established couldn't be broken in broad daylight. They said silver was too liquid, too deep, too global for a sudden liquidity shock to do that much damage that fast. And yet it happened. Not months, not weeks. In 48 hours, the market flipped from a story about scarcity and momentum to a story about forced liquidation and collateral. Here's the part that changes how you see the whole move. This wasn't primarily an inflation story. Inflation is slow, political, and endlessly debated. Inventory is fast, physical, and binary. Either deliverable metal is there when it's demanded or it isn't. And when the system senses that the answer might be it isn't, the first reflex is not a price explosion. The first reflex is risk control, margin hikes, tighter terms, higher collateral. A silent message that says, if you want to play, you need more cash than you thought. And while most people were trying to explain silver in the usual language, rates, CPI prints, the dollar, or broad commodity cycles, institutions were watching something else. They were watching deliverability. They were watching where metal sits, how it can move, and what it costs to turn a paper promise into a physical bar. That's an information gap. And in markets, information gaps become wealth gaps. Welcome to Vaultline, where we decode what matters before it becomes a headline. If you like analysis that follows the mechanics instead of the talking points, consider subscribing the way you'd keep listening to that calm voice who always seems to notice the storm forming first. And as you watch, drop a comment with where you're listening from, because this market story is global and the signals don't look the same in every region. Now, let's reconstruct what happened with forensic clarity, because the details matter. In late 2025, silver had been trading with a kind of unstable confidence. There were reports of silver clearing $60 an ounce. One print cited around 60.4, after more than doubling since January 2025. That kind of move attracts everyone: trend followers, short-dated option buyers, momentum funds, and retail excitement. But it also attracts something else: stress tests. When price rises quickly, exchanges and clearinghouses begin to ask a simple question: can every participant withstand the next move without turning the system into a cascade? The CME's margin increase on December 29th wasn't a press conference. It was a lever pull. It effectively told the market that volatility had crossed a line. In practical terms, each futures contract represents 5,000 troy ounces of silver. Multiply that by the margin requirement, and you get a blunt reality. A single contract can demand tens of thousands of dollars in collateral just to exist. Raise the margin, and you raise the immediate cash needed to hold the same position. Some participants can post it without blinking. Others can't. And the market doesn't wait for them to catch up. That's why margin changes are so powerful. They don't need to predict direction. They force behavior. And when enough people experience that at once, price can cascade. Before you even get to inventory, notice what the margin math implies about leverage. A single silver futures contract controls 5,000 ounces. If silver is around $60 an ounce, that's roughly $300,000 of notional exposure in one line item. With margin around 25,000, that's leverage in the neighborhood of 12 to 1. That leverage is not automatically reckless. It's how futures are designed. But it means small rule changes have outsized effects. Add $3,000 of required collateral, and you just increase the cash burden by 12% on that contract, instantly, with no negotiation and no grace period. Now zoom out. Margin doesn't only hit speculators, it hits the entire chain of participants who use the futures market as a pricing and hedging engine. Dealers who hedge inventory, fabricators who hedge orders, even firms managing exposure across multiple metals. When margins rise, capital gets tied up. And when capital gets tied up, something else gets sold somewhere else, because portfolios are connected. This is why a silver story sometimes looks like a broader risk event. Not because silver controls everything, but because collateral is shared across positions, and a margin hike can force a rebalancing across assets that appear unrelated. This is also why you can see a market sell off at the exact moment the underlying narrative sounds most bullish. If the market is crowded, the story can be true and still be untradeable in the short run. The price can fall, not because scarcity vanished, but because the cost of carrying the position rose faster than participants could adapt. And that creates a telltale signature: fast drops, followed by stubborn resilience in certain parts of the physical chain. If this were a normal sentiment reversal, you'd expect everything to soften together. But in inventory stress events, what softens first is paper exposure, And what stays firm is the real-world cost of sourcing. At the same time, another data stream sat in the background quiet but loaded. London's vault reporting showed end December 2025 silver holdings of 27,008, 118 tons, roughly 927,254 bars, valued around $64.4 billion. On the surface, that sounds like abundance. Tens of thousands of tons, almost 1 million bars, a number big enough to stop a conversation. To see why total can mislead, you have to understand that vault numbers are not the same as free float. Some metal is allocated to specific owners and is not for sale at any reasonable price. Some is tied up in long-term financing arrangements. Some is sitting in forms that are technically bullion, but not immediately deliverable into the exact system where demand is spiking. And some can move, but only with frictions that don't show up on a chart. Transport scheduling, insurance, security, customs paperwork, assay verification, and sometimes recasting into different bar sizes. Even within a single city, the distinction matters. A bar can exist in a vault, yet be unavailable to satisfy a sudden need because it's pledged as collateral committed to an industrial buyer, or simply not in the right category to be used for delivery under a specific contract. That's why conversations about eligible versus registered inventory exist in the first place. The labels aren't marketing. They're a reminder that metal can be present but not offered. And when that friction meets urgency, premiums appear. Premiums are not always panic. Often they are just the price of immediacy. The physical market is asking, how much extra must be paid to guarantee the bar shows up on time, in the right form, through the right channel? In a calm market, that number is small. In a stressed market, it jumps, because time becomes the scarce resource. This is where geography starts to matter. Silver is global, but demand is not evenly spread. Manufacturing hubs pull metal differently than investment hubs. When one region pays up, flows redirect, unless something blocks them. A refinery backlog can block them. A shipping disruption can block them. A sudden surge in coin and small bar demand can block them because large bars must be converted. None of that requires a conspiracy. It only requires a system that was optimized for normal times. They run on what can be delivered under the specific rules, timelines, and locations that matter at the moment demand spikes. And that's where dislocation begins. If the story were simply inflation, you would expect the signals to line up cleanly. Higher prices, higher speculative participation, and broadly consistent scarcity narratives everywhere. But the data shows something else entirely. Positioning numbers suggested not everyone was wildly long at peak stress. One CFTC reported figure showed silver speculative net positions around 23.7 thousand in a late January 2026 release. If positioning isn't extreme, then something else is adding pressure. And then you have the most revealing piece, delivery behavior. A month-to-date stopped figure of 2,955 silver contracts as of February 3rd, 2026. Remember, 5,000 ounces per contract. That's about 14.775 million ounces in physical equivalent terms seeking delivery month to date. You can debate sentiment all day, but you can't debate math. Delivery math is a flashlight. So what's the central mystery? It's this. How can a market simultaneously trade like it's overflowing with inventory and yet behave like it's short on deliverable metal? How can London report massive tonnage and the futures market still react as if the system needs to slam the brakes with margin hikes? The pattern is not about price alone. It's about the chain of obligations. In 1980, silver became the stage for a legendary squeeze narrative. The details differ depending on who tells it, but the broad structure was the same, concentrated. Buying pressure met a system designed to manage risk. As price accelerated, the rules changed. Margins rose. Trading conditions tightened. The result was not a gentle cooling. It was a violent reversal that punished leverage and rewarded liquidity. The lesson wasn't that silver is special. The lesson was that when position concentration grows and the system senses instability, the first response is to tighten the terms of participation. In 2011, silver ran again, rising sharply into the high 40s. And then a familiar playbook appeared, a series of margin hikes that tightened the screws. The market didn't just drift lower, it broke lower because the cash demands hit. At the same time, participants were already stretched. But the mechanism is the same. When volatility rises, the exchange increases collateral requirements, and leverage is forced to shrink quickly. And now in 2025 into 2026, it's happening again, but with a twist that most people miss. The catalyst isn't the inflation rate. The catalyst is inventory stress showing up in deliverability and in the cost of turning paper into metal, while liquidity rules amplify every move. Here's where it gets interesting. Institutions don't need to coordinate to create this pattern. They just need to follow their incentives at the same time. Exchanges want stability, clearing members want reduced risk, banks want orderly markets. Industrial users want certainty of supply. And funds want to avoid getting stuck in a position that can't be exited without damage. When those incentives align, you see the same sequence. Volatility rises, collateral tightens, and price whipsaws. Now, let's talk about the players, not as villains, but as roles in a system. First, the exchange and clearing apparatus. When the CME raises margin, it's responding to volatility and perceived risk in the clearinghouse. The margin is not a fine, it's a buffer. But the moment it changes, it acts like a policy shock, because it changes who can stay in the market and who gets pushed out. Second, you have the large commercial participants who use futures to hedge. For them, silver is not a trade, it's a risk management tool. If they are producers, they hedge revenue. If they are fabricators, they hedge input costs. If they are dealers, they hedge inventory. Their positioning is often misunderstood because it doesn't map cleanly to a bullish or bearish view. It maps to exposure, and exposure changes with orders, supply agreements, and production realities that never show up in a social media chart. Third, you have funds and speculators, some systematic, some discretionary. When volatility spikes and margin rises, systematic funds often reduce risk because their models tell them to. Discretionary traders may be forced to reduce risk because their brokers tell them to. Either way, selling can become mechanical. The market can look emotional, but the engine is often a spreadsheet. Fourth, you have the physical market, vaults, refiners, mints, and the distribution chain. This is where the story becomes real because physical silver is not one homogeneous blob. It's specific formats, specific purity, specific bar sizes, and specific locations. A bar in one vault is not the same as a deliverable unit in another system if it can't be moved quickly, reassayed, or converted into the required form without time and cost. Plenty where? In what form? Under what constraints? The market isn't asking whether silver exists on Earth. It's asking whether deliverable silver exists in the right place, at the right time, under the right rules. That brings us to the dislocation, paper versus physical and west versus east. On one side, you have a futures price that can fall 11% in a day because margin terms changed and leveraged participants had to sell. On the other side, you have regional physical markets that can trade with premiums when supply chains tighten and demand concentrates. A premium is the market's way of saying the posted price is not the whole price. And this gap cannot persist indefinitely, not because of ideology, not because of internet slogans, but because arbitrage tries to close gaps whenever it can. If physical is expensive relative to paper, metal flows toward the premium if it can. If it can't, the premium widens. When the premium widens far enough, the futures market becomes less informative about real-world availability, and the physical market becomes the true signal. Think of it like airline seats. A website can list a flight at a certain price, but if every seat is effectively spoken for, the real cost becomes higher, or the seat becomes unavailable. The listed price doesn't guarantee access. In silver, the listed futures price doesn't guarantee a bar. It guarantees a contract. Delivery is the bridge. Inventory is the bottleneck. So how does the mechanism actually work when inventory tightness meets exchange risk controls? First, rising prices and volatility increase the clearinghouse's risk estimates. Second, margin requirements rise. Third, leveraged participants must post more collateral. Fourth, some participants liquidate to meet the call. Fifth, price falls rapidly, which triggers more risk reduction and sometimes stop-loss cascades. Sixth, the headline becomes silver crashed, while the underlying physical tightness may remain, because a margin call doesn't manufacture a single new ounce. That's the key contradiction. Price can fall because of liquidity, while physical tightness persists. Because of inventory. Those two realities can coexist, and they often do at turning points. Now, let's ground this with the numbers that matter. London Vault data reporting 27,818 tons sounds like a mountain. But a mountain doesn't help if it's fenced off, leased, encumbered, or simply not moving. A bar count of 927,254 is impressive, but bars are not the same as deliverable floats when demand shifts to a specific venue in a specific timeline. On the futures side, 5,000 ounces per contract means delivery demand scales fast. 2,955 contracts month to date implies about 14.775 million ounces standing for delivery in that slice of time. That's a meaningful pulse of demand that has to be satisfied by available, properly deliverable inventory, or by metal being mobilized from elsewhere. And then there's the psychological anchor of price, a market printing around $60.4 an ounce after more than doubling since January. 2025 is a market that has drawn attention. Attention brings participation, participation brings leverage, leverage brings vulnerability to margin shocks. That's how you get a market that feels unstoppable on the way up and then suddenly feels fragile. One more nuance makes this even clearer. When inventory is the issue, the market often signals stress in places that casual observers never check. Sometimes it shows up as unusual spreads between near-month and later-month contracts. Sometimes it shows up as rising urgency to borrow metal for short periods, reflected in leasing and financing conditions. Sometimes it shows up in the behavior of large inventory pools, like exchange-traded products, where metal can be added or removed in response. These are not esoteric details. They are the difference between a price story and an availability story. A price story can be argued about on television. An availability story has to be solved with logistics and collateral. And logistics and collateral are what move first when a market is approaching a boundary. So what does this mean going forward if you strip away the hype and look at the pattern? Historically, when you see a combination of rapid price appreciation, margin shocks, and heightened delivery interest, you don't get one clean outcome. You get a sequence. Scenario 1 is conservative. Volatility cools, margins remain elevated, and the market digests the move. In that scenario, the key signal to watch is whether delivery pressure eases and whether physical premiums normalize. If premiums fall and delivery interest declines, the stress event may have been primarily speculative. Scenario 2 is moderate. Volatility remains, but the physical market stays tight. In that case, paper prices can whip around while the physical cost to source metal remains stubborn. The market becomes a tug-of-war between liquidity-driven selling and inventory-driven demand. Scenario 3 is aggressive. Deliverability becomes the dominant story. If delivery demand continues to rise and available inventory fails to keep pace, the system has to respond. Sometimes it responds through higher prices, sometimes it responds through tighter terms, sometimes it responds through both. The tell is not a viral headline. The tell is whether the gap between paper pricing and physical availability widens, and whether rule changes continue to appear at key moments. The indicators to watch are mechanical. First, further changes in margin requirements, because those are the exchange's real-time assessment of risk. Second, delivery statistics, and whether the volume standing for delivery remains elevated. Third, positioning shifts, including whether speculative net positions expand sharply or stay modest, because that tells you whether the move is being fueled by a crowded trade or by something else. Fourth, regional premiums and reported tightness signals, because those reflect the cost of immediacy in the real world. And that brings us to the choice ahead, not in the sense of what anyone should do, but in the sense of how to interpret what you're seeing. There are two ways to watch silver. One is to watch it as a macro story told through inflation and central banks. The other is to watch it as a micro story told through inventory, delivery, and market structure. The first story is broad and slow. The second story is precise and fast. The divide isn't about intelligence, it's about attention. Most people look where the light is brightest, and the brightest light is usually the simplest narrative. Inflation, fear, greed. But the market often turns on quieter switches. Collateral rules, warehouse flows, delivery mechanics, and the cost of converting paper claims into real metal. Institutions move first because they monitor those switches. They don't need to predict a headline. They just need to see stress building in the pipes. Retail moves last because retail hears the story after the move, and by then, the rules may have changed. If you remember one thing from this entire episode, remember the role of inventory. Inflation can explain why people are interested. Inventory explains why the market behaves the way it does. When inventory is perceived as tight in the places that matter, the system becomes sensitive, it becomes reactive, it becomes prone to sudden policy-like moves, such as a $3,000 margin hike that turns an ordinary day into an 11% downdraft. Because structure is what repeats. If the next headline talks about inflation again, remember December 29th, 2025. The market's loudest message was a margin notice, not a speech, sent to every participant. This is Vault Line, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. And keep this in mind as the next wave of data comes in. The question isn't whether silver will keep surprising people. The question is whether the signals in inventory and market mechanics are being watched before they force the next surprise.